Welcome back to Investing Talk Podcast. Today we are focusing all of our attention on DeFi Development Corp. This is a name that has really rocketed onto the institutional radar, mostly thanks to an incredibly aggressive capital strategy, one that's heavily focused on Solana assets, and also a compelling expansion into commercial real estate finance software.
Exactly. So for you, the listener, the core question we're tackling today is pretty straightforward. Is DeFi Development Corp a good time to buy right now?
Right.
I mean, given its extreme volatility, its high momentum history, and this very recent pivot to consistent profitability, our mission is basically to distill the sources and tell you what the market signals are saying.
Okay, we'll get right into the analysis. But first, just a quick reminder, please remember to hit that subscribe button, give us a like, and leave a comment below.
Yeah, definitely helps us out.
And if there is a specific company you want us to look into, please leave a comment below too.
All right, let's start with what makes this company, well, so unique. DeFi Development Corp is effectively a proxy for two massive investment narratives at the same time.
Okay.
You've got pure digital asset exposure, specifically the Solana ecosystem, and then you have genuine fintech innovation through its proprietary software division.
So they're kind of straddling two worlds.
Pretty much.
Yeah.
They've managed to position themselves as an emerging institutional leader in digital assets while also selling B2B software. It's an interesting mix.
Okay, let's unpack that aggressive capital strategy then, because that seems to be the foundation of the current bullish thesis, right?
Absolutely.
So back in September 2025, the company announced a, frankly, stunning $100 million share repurchase authorization.
Yeah, huge number.
And this isn't just a passive thing. The goal they stated is explicitly to reduce outstanding shares and, crucially, amplify the Solana per share value.
The mechanism there is, well, it's brilliant in its simplicity, really. Well, if they hold a fixed amount of Solana, let's say $500 million worth, and then they use these buybacks to reduce the total share count,
Okay.
they're basically taking that same asset value and dividing it by a smaller number of shares.
Yep.
So every remaining share holds a geometrically increasing amount of, Solana asset value.
Ah, got it. So it's a high conviction bet on both their own stock and the underlying SOL asset.
Precisely. And they funded this commitment too.
Right. They expanded that convertible note financing to $112.5 million earlier this year.
And that capital wasn't just sitting idle. It was specifically earmarked to fund those SOL acquisitions and support the buyback efforts. It really cements their liquidity and growth capacity.
And there was that management change, too, wasn't there, promoting Dan Kang?
Yeah, the chief strategy officer.
Yeah.
That signaled to the market that this, aggressive capital market strategy is now a core internal priority. It integrates treasury management directly with market sentiment and outreach.
So if we look at the whole picture, we see that duality you mentioned earlier.
Yeah.
On one side, you've got the core blockchain strength, this massive treasury allocation to SOL and growth in their validator infrastructure. And on the other side, you have this profitable SaaS expansion offering commercial real estate finance data solutions using their platforms like Janover Pro and Janover AI.
And that two-pronged revenue stream is fundamentally what sets them apart from, other digital asset peers who are purely reliant on crypto market moves.
That dual identity seems key.
It's absolutely the key to understanding its valuation.
Okay, well, that aggressive strategy has clearly paid off in some ways. Let's turn to the numbers, because the financial reversal seems pretty sharp.
It really is.
The cornerstone of the bullish case seems to be this dramatic financial inflection point, right? This rapid transition to profitability.
Exactly.
Trailing 12-month, or TTM, revenue is now $3.52 million. That's a noticeable acceleration from, $2.1 million just a year earlier?
And the transition from loss to profit is, it's startling. They reported TTM net income of $13.70 million.
$13.7 million.
Oh, wow. Yeah, contrast that with a prior year's loss of about $2.73 million. It's a complete reversal.
Yeah.
It signals that the strategic pivot has, found some real traction.
But here's the crucial question, I think. The one that distinguishes a quality investment from maybe a flash in the pan?
Go on.
Is that $13.70 million net income primarily driven by the underlying appreciation of their, let's face it, highly volatile Solana treasury? Or is it genuine operating profit from that recurring revenue Janover SaaS platform?
That distinction changes, everything. And while the sources don't break down that TTM profit perfectly,
Okay.
the market appears to be giving them credit for sustainable earnings. because the TTM earnings per share stands at $1.17.
Right, and that results in a TTM price to earnings, or PE, ratio of 13.6. So what does that PE of 13.6 actually tell us in context?
Well, if you connect this to the bigger picture, it really suggests the market is still discounting the stock pretty heavily, probably due to the inherent volatility of the crypto treasury side of the business.
Right.
I mean, typical high-growth, pure-play SaaS or fintech peers often trade well above a PE of 20, sometimes much higher.
So the fact that DeFi Development Corp is trading at 13.6, despite showing these robust profits,
it signals skepticism. Skepticism over the stability of those earnings. And this gap right here is where the opportunity might lie if that SaaS growth proves sticky and reliable.
Interesting. Well, skepticism aside, Wall Street analysts are certainly leaning bullish.
They are.
At least 2 Wall Street analysts rate the company a strong buy, and the consensus 12-month price target range sits between $35 and $45.
Which, from the current level, around $15.23.
Implies a massive upside, like 115% to 180%. Cantor Fitzgerald, for instance, has a $45 target out there.
And this optimism isn't just floating in thin air. It's grounded in a strong balance sheet. The current market cap is around $410.7 million.
And importantly,
crucially, public financials show no evidence of high leverage or, significant debt burdens. That financial flexibility is key. It's what allows them to confidently pursue that aggressive buyback and acquisition strategy we talked about earlier.
Okay, now we absolutely must address the sheer price action here. This stock really defines high risk, high reward. It's definitely not for conservative investors.
Not at all.
Looking at its history, as of mid-June 2025, the stock was up, get this, 24,506% year-to-date.
Extraordinary. That kind of parabolic movement explains the massive 52-week range, right? Stretching from a low of just lira of 49 cents to a high of $53.88.
Wow.
It confirms 2 things for any potential investor. 1, explosive momentum, and 2, extreme volatility. You have to factor in the potential for these massive swings.
Absolutely. So looking at the short-term technicals, where are we now? Hovering around that $15.23 mark.
We need to watch the key levels. Psychological support seems pretty firmly established at $15. That's a level that's held to the recent consolidation.
Okay, and resistance.
On the resistance side, we're looking up near $16.50.
Yeah.
That's where the 50-day simple moving average currently sits.
10 momentum?
Momentum indicators like the 14-day RSI are around 57.9, which is sort of neutral bullish. It suggests there's still room before the stock hits typical overbought territory.
Okay, let's talk risk then, starting with company-specific factors. We mentioned the sharp profitability inflection is very recent.
Very recent.
So if market adoption for those SaaS products suddenly stalls, or, if the Solana price reverses dramatically.
Rapid return to net losses is definitely a distinct possibility. That's a risk you have to acknowledge.
And then there's the elephant in the room, sector-wide risk.
Always a factor in the space.
Right.
The entire decentralized finance sector is subject to sudden, unpredictable regulatory shifts and just massive sentiment reversals.
True.
But maybe the most fascinating risk factor is the one kind of hiding in plain sight. That highly negative beta value of negative 7.29.
Okay, that number sounds technical. What does a negative beta like that actually mean for the everyday investor?
It means the stock is almost completely decoupled from the broader market. A negative beta of nearly -7 signals that when the S&P 500, for example, goes up 1%, this stock historically tends to move in the opposite direction.
Opposite direction. By how much?
Well, potentially dropping 7% or more in this case based on that historical beta. It suggests the valuation drivers are entirely unique to the crypto and fintech spheres.
So it won't necessarily offer diversification or track general market movements?
Exactly. It's both potentially a unique hedge and a massive volatility risk baked in. It behaves differently.
All right, let's pivot to the potential upside then. What confirmed events are coming up over the next, say, 3 months?
Okay, the immediate focus has got to be the Q3 earnings release. Analysts expect it will fall around October 24th or possibly November 5th. Sources differ slightly.
And what are analysts looking for there?
They're explicitly looking for management to reaffirm that aggressive share buyback pace and hopefully provide some concrete details on further Solana acquisition plans.
Earnings are huge, yeah. But institutional confidence is also a major catalyst, right? We have that major institutional 13F filing scheduled for December 4th, 2025.
That's a big one. That document will be the first solid, verifiable signal of which institutions have actually bought into the DFDV strategy following its profitability pivot.
Seeing big names on that list could definitely fuel the next run.
Absolutely. And beyond those company-specific dates, we also have some structural market events in November,
Like,
ETF rebalancing around the 15th, and the traditional Thanksgiving week report around the 21st. These could drive volatility as crypto and fintech sector weights potentially shift across indices.
okay. Finally, let's turn to the high-impact speculative buzz.
Yeah.
The rumors that could lead to truly massive upside if they pan out.
Right, the unconfirmed stuff. Market chatter hints at advanced talks with a top 10 U.S. commercial bank.
A top 10 bank. What's the rumor specifically?
The high-profile rumor is that this bank is looking to integrate Solana-based settlement rails directly into its commercial lending platforms.
Wow, that would be huge.
It would represent a massive institutional validation, both for the company and for the Solana ecosystem as a whole, really bridging traditional finance and DeFi.
Absolutely. And what else? We also have the continued speculation regarding eligibility for inclusion in a tech-focused Nasdaq index, right? Following their market cap surge and improved liquidity.
Yep, that's still bubbling away.
Yeah.
And finally, there's buzz surrounding a potential new SaaS platform launch,
Oh, yeah.
leveraging artificial intelligence, supposedly, to automate complex commercial real estate debt underwriting. That would significantly enhance their dual revenue stream model by really solidifying the SaaS side of the business.
Lots of potential catalysts then, both confirmed and rumored.
Definitely. So to synthesize everything we've looked at, the overall rating based on our source material for DeFi Development Core is decidedly bullish. It's scoring high due to that rapid profitability jump, the robust Wall Street analyst targets implying significant upside, and, well, the sheer number of near-term catalysts we just discussed.
So what does this aggressive profile mean for you, the listener?
It means the stock seems suited for potentially two types of investors.
Yeah.
Short-term traders, maybe looking to leverage those upcoming earnings and institutional filing dates.
Okay.
And also perhaps for long-term investors, if you really believe in their platform moat and their potential for institutional leadership in digital assets.
The core tension, though, it seems to me, remains this. Sentiment is decisively positive right now, and that fundamental operational growth appears established, at least recently. But the risk hinges entirely on whether management can successfully pivot and grow its expanding commercial finance SaaS business alongside its core, highly volatile blockchain asset treasury.
That balancing act is absolutely crucial to maintaining the quality of those earnings we talked about.
Right.
And that leads us right to our final thought for you to chew on.
Yeah.
Given that PE of 13.6 and the current market discount, which of DeFi Development Core's segments? Is it the institutional digital asset leadership fueled by the Solana treasury? Or is it the commercial real estate fintech platform? Which one will ultimately be the primary engine for margin expansion 3 years down the line?
And why does that distinction matter?
Well, it matters profoundly when determining if the company can eventually earn that higher SaaS-style valuation ceiling that the market isn't giving it right now. Which engine drives the long-term value?
That is something critical to keep an eye on going forward. Thank you for joining us for this exploration of the sources on DeFi Development Core.
My pleasure.
We will see you next time.